Well, welcome everyone. Glad to have you here. Have a lot of content to go through today. Bruce and Patrick have been working a lot with me on the presentation, and I tell you, a lot of info. Just wanted to give a quick introduction. So for those of you, I think pretty much everyone here is familiar with Whalen. But here at Whalen, one of our core values is an aim high. And to us, that means client service is not just about delivering those services, but also helping inform and educate and, just try to elevate everyone to a higher. Well, without further ado, I will hand things over to Patrick and he can get started for us.
Thank you. Well, I really do appreciate everybody taking this time, here. So we're going to make it really good for you. So there's how many people are very familiar with this one big beautiful bill already and how it affects them? Pretty familiar? Just a little bit familiar? Do you think positive about it? Positive generally? Okay, what is if you were going to say or maybe by the end of this presentation, you'll say, what is the most positive thing about it that is beneficial to you and your business and what you think will help out, with the whole taxing system? Okay, so if you do the slides for me,
And there is a pointer right there if you want to use that.
Yeah, I never do that real good. Okay. So if I just go like this, it's okay to go ahead and proceed. Is that cool? That'll work. Okay, so the biggest thing as part of the one big beautiful bill has to do with the income tax rates in which our income is subject to tax. So everybody knows we have all this income, and then we have deductions, and then we get to something called taxable income, and then we compute the tax based upon that taxable income. And in the United States, we have a gradual structure. Okay, and so we have different. So like before the Big Beautiful Bill Act, we had these 7 tax rates: the 10%, the 12%, the 22%. 24%, 32%, 35%, and 37%. That's an awful lot of rates, right? Now, with the act, it made these rates permanent. So forevermore, you can use these rates and in these specific income brackets to calculate what your tax liability will be. So your income after your deductions, it's made permanent. So if you proceed to the next slide. Okay, these are those particular brackets for 2025. Okay, and they're going to only increase, or get larger, and the numbers will get higher as we go further because it's inflation adjusted. So that's kind of a neat thing. Like if you're getting this much of a deduction, it's sort of like the old AMT, the alternative minimum tax. Everybody used to start getting subjected to alternative minimum tax, and that wasn't the intent of alternative minimum tax. But because the rates were not inflation adjusted, people were getting subject to it, much earlier. Now, what would the rates have been if the act was not passed? Okay, that's the next slide. Okay, so I don't know if people's eyes caught it, but now back then the rates were 10, 15, 25, 28, 33, 35, and 36.9. And if we just flip back and we look at a couple of these, this is for the married filing joint, just to show. So the top bracket is $751,600 or more. Okay, and then the old one, the old bracket. We go forward, okay? 39.6 at 470,000. That's an awful lot of income. I mean, just so the one thing that the act did is it took these rates and made them not come back. Okay. So the second thing it did, okay, is the standard deduction. everybody's, I think, a big fan of a standard deduction, especially a standard deduction that's big enough and beneficial enough for everybody. So before these higher standard deduction, well, we'll kind of like give you what these are now. So a single or married filing separate is $15,750, head of household $23,625, and married filing joint, the standard deduction is $31,500. Now, the standard deduction and the itemized deductions, you compare the two and you pick the deduction which is the largest for you. The one that gives you the biggest impact. Now, just because the standard deduction is $31,500 doesn't mean that that's all you can take. It's an either or thing. It's whether or not your itemized deductions, when we add all of those up together, end up being more for you or not. Well, with this standard deduction, it greatly simplifies taxes for everybody, by having this larger amount, because you don't have to worry about, getting all of those charitable contributions together. You don't have to worry about getting all of the state and local tax deductions, exactly perfect. Do you remember how difficult that was to get that? Because you've got like all of these dates in which you're making these payments, and so you might have state income tax, you might have school district income tax, you might have city income tax, and you have property tax, and so this larger standard deduction. So I believe there's like a statistic, and how they say like 60% of all statistics are made up. It's like, so I try not to, like give a statistic. But if I was going to give one, it's almost like 14% of the people, it would have been almost double, would have to itemize, or 32, something like 28, 32 people, percent of the population was itemizing, and now it's 14%. So it like took a whole lot of that, compliance out of the compliance thing. And an IRS examiner, they can't, pierce this. This is my number right here. It's the standard deduction. It's what I'm allowed. Okay. No, go back, please. Okay. So that was just this part of that slide. I'm sorry. It was probably a lot windier. But then the mortgage interest deduction, that is something that is part of this whole thing of itemized deductions, this mortgage interest deduction. And so if you borrow $750,000, you can deduct the interest on that $750,000. Now, let's say it was $1 million. Well, then you can't deduct. Your interest deduction is limited to just the amount on the $750,000. So the part that becomes non-deductible is the $250,000 that remains. It's not like all of your interest is not deductible at that point. It's just you ride it all the way up to the top of the limit, and then after that, it's non-deductible. Well, the enactment of the bill made the $750,000 limit permanent. Now, right down here is the home equity debt. And a lot of folks go, okay, well, that what does that mean? This whole saying in here. So it's like, you use home equity debt to buy a car, which you're perfectly able to do, right? You go to the bank, you get a home equity line of credit. They don't ask you what you're going to use the loan for. Well, that interest, if you use it for a car, it's not deductible. But if you use it to buy, build, or improve your main residence, it can be deductible as long as it's below that $750,000 limit. And that's also made permanent. Okay, next slide.
Okay, question.
Yes, sir.
So, you go back. First of all, two questions. One, is there any COLA on the 750?
COLA on the 750.
Like, does it go up over year?
Oh, I see what you're saying. Cost of living adjustment. Yes. No.
Okay.
No, the 750 has been steady. Hi, Cindy. Has been steady for a while, since 2017.
Okay, and then the other question is, there's home equity lines, and then there are second mortgages, and they're two different things.
Yeah.
If you had a second mortgage and the two mortgages together were less than 750, would you be able to write off both?
Absolutely.
Okay.
Because these are wonderful questions. Thank you very much. I encourage participation in so like if it's at all not clear, just hit me up on it. It's perfect. So the whole reason why it's deductible is because it's secured by your main home, or it's secured by you can even have a second residence too, and still be able to get a deduction for it. Okay. Charitable contributions. Okay. So first off, we'll go with the folks that itemize. Okay, so you've got the standard deduction folks, and then you've got the itemization folks. So the ones that can itemize their charitable contributions. Okay, when it says here you can deduct a portion of your qualified charitable contributions subject to specified limitation, that's because certain types of charitable contributions you could only do up to a certain amount of your income. So like if you gave cash contributions, you could do 60% of your total income. You couldn't go, do wipe out all of your income with all of your cash contributions. I mean, it'd be really great if you could, but they limited it to 60%. And any amount after that 60%, you could carry it forward. And then there is my favorite, which is the donor advised fund charitable contributions. If you've ever heard me speak at any kind of presentation, the donor advised fund is perhaps the most efficient way in which to give charitable contributions, because what you're doing is you're giving stock or appreciated mutual funds. So like, let's say it cost you $10, but now it's worth $100. Instead of you selling the $100 stock and realizing a $90,000 gain and paying tax at 15% or 20%, depending upon your tax bracket, you can give the entire $100 to the charity and get the entire $100 as a deduction on your tax return. And that would go towards working towards whether or not being itemized is better. Okay. And then what's kind of new as part of the bill is for the non-itemizers. So non-itemizers are allowed, so anybody that gets a standard deduction, so it's sort of like standard deduction on steroids, because you get an additional amount, is you can, but this is with cash though. This is not with a donor advised fund. You have to do it with the cash. And a lot of people, like I see lots of tax returns, and they'll have this much in cash and they'll have this much in donor advised fund. And I sometimes go, well, why don't you have that all in donor advised fund? Well, right now, they're going to be the ones that are doing it right because they have this in this, the cash amount. Okay. Any questions? Yes, ma'am.
Is this starting in 2025 or in 2026?
Yeah, I think it's going to be the 26 for this new extra line item on the tax return. Yeah, they probably couldn't fit it in with all the other stuff that they're putting into 25.
And then with the being cash contributions, let's say somebody donates an automobile, would that be the same as donating the stock? Then that wouldn't be.
That would be, yes, a gift of property. Yes.
So it would not be included. It would only be cash.
Right. Yeah. It'd be just so it's like you go through these, like I like to think of things like in hurdles, maybe there's hula hoops that you have to go through. So the first one is do you standard or itemize? And then the second thing is it a cash contribution? Is it a stock contribution? So cash is going to be 60% limit, stock is 30% limit. And then you have the wonderful private foundations that have a 20% charitable contribution limit. And then you can carry that forward, though, if it's not used, and you carry it forward for 5 years. Unlike a capital loss, you carry forward indefinitely, until you use it. Okay. This one here is the biggie. Okay. The state and local income tax, the SALT cap, And in my phone, which I strategically left in my office on purpose because I don't want to have my phone with me when I do a presentation, I had taken a picture earlier this week of a map that had all of the states on it and what the tax rates were. And let me tell you, we're very blessed to live in Ohio because the tax rate in Ohio is 3.5%. And the tax rate in the highest state is California, is 13.3%. Could you just imagine on top of the taxes that you already pay, you throw another 10% to the government? Well, I couldn't imagine that. Who spends your money better, you or the government, right? But we have to cut that part out. Wait, I think we have to go back to that one because I didn't quite give this one enough stuff. Okay, so it's a $10,000 cap is what we used to have. So you'd have $20,000 in real estate taxes, $40,000 in state and local income taxes. So that's $60,000. But on your tax return, Patrick he shows you, you've got $10,000 on the state and local tax line. And the first thing is, hey, wait a minute. I think your adding is incorrect. Well, it wasn't incorrect. That's just how the tax rule went. There were some gives and some takes. And one of the gives was this SALT cap, that being the $10,000. Well, now starting in 2025, okay, it's up to $40,000. So do you remember where we were at with that standard deduction? Is we were at $31,500 for married filing joint. Okay. Well, right now, when you're looking at your itemized deductions, you can use up to $40,000 with state and local income tax. Now, what are other common itemized deductions? Mortgage interest would be one. Okay. Medical expenses would be one. But when medical expenses end up being part of your itemized deductions, that's usually not a really good thing because to get high enough for it to be meaningful for you, it has to exceed 7.5% of your adjusted gross income. And so like if you had $100,000 in income, you need $7,500 in out-of-pocket medical expenses. And rather than doing medical expenses, well, I guess I would say that exceed that 7.5%, it's much better to, of course, be lower than that. But if you are going to have medical expenses, has anybody heard of health savings accounts? Mm-hmm. Health savings accounts are a wonderful thing. And I would also encourage folks to not only contribute the amount that you're going to use this year into the health savings account, but create a savings account. It carries forward. You can use this in retirement. Like you throw, what is the max? Is it 9,000 something? 9,000 something?
No, not extra 1,000 if you're 55.
Right. All those extra things. Yeah, if you're, what do you call it? You've got the most time in service. You're 55 and above. You get that extra $1,000. So if you don't have a health savings account, or you have the ability to have one and you're not funding it, this right here, next to the donor advised fund, it's on like Patrick's top list of things that you want to have because you can have this money in a fund for you to use for all of your future medical expenses that's earning interest tax free. So if you're earning $1,000 in interest income in that, it's tax free as long as you pull it out for medical expenses. Okay, now
isn't that like one of the biggest tax hacks on the personal side is the HSA?
Yep. It's
the only vehicle I'm aware of where it's tax-free going in and coming out. Are there other vehicles like that?
Mm-hmm.
What are they?
Mm-hmm. So the donor advised fund would be a tax hack. The 529 plan contributions is a tax hack. You don't get a deduction for federal income taxes when you put that money into the 529 account, but you can for the state. However, not all states' plans are equal. Some states' plans offer a better return. And so a deduction in a 3.5% state like Ohio might not be as meaningful for you as a return of 13, 14% over what the Ohio plan does in a particular year. So always working with your financial advisor in terms of which plan, to get into is a good idea there. Yeah, sometimes the deduction is not the best plan.
And hopefully we're all planning on getting old and needing an HSA at some point. So it's going to be either in your 401k, an HSA, or other alternatives. And at least for me, I'm maxing out my HSA before I put towards my 401k, simply to allow it to grow for medical issues.
And then it just like Cindy said, when you get to a certain age, you're allowed to put a little bit more in. So, it's recognized that when you're planning for this later on, you need to have the ability to put more in, because maybe when we were younger, we couldn't put as much in. Instead we were doing other great things with our money, like living and going on trips, paying for school and for kids and all that stuff. Okay. Does anybody have any questions about this? The other thing too is this 40,000 isn't for everybody, as the slide says. There's also an income cap. So when you get above 500,000, so going between 500,000 and 600,000, that 40,000 starts going in the wrong direction. But where does it stop? It stops at the 10. Okay. And then in 2030, this is one of those ones that's a temporary change. So like we like the tax rate change, because it was permanent. This one here is just temporary. And in 2030, it goes to 10,000.
So is it correct to say that every $10,000 of additional income decreases your self-deduction by $3,000?
Okay, I would have to see that on a piece of paper, but if you go between 500 and let's see here, 500 and 600,000. Sometimes I have to get Bruce involved when it involves math and higher calculus calculations. But so from 600,000 to 500,000, that's $100,000. Okay, and the reduction.
Let's just say it's half. So you make 550. Are you losing 50% of the distance between 10 and 40?
Yes.
Okay. That's an easier way to ask the question. Okay, that makes sense. I just wanted to make sure I was following.
Yeah. It doesn't have like a skewed burn off, like our tax rate schedule or something like that. Yeah, it's linear. Okay. And I think we can go on to the next slide. Okay. So this piece limitation, this is just it was something horrible that would limit people's itemized deductions. Well, they've made that go away, and instead they're having a thing that it just affects the highest tax bracket folks, where it is changing the amount of their deduction. Okay, let's see here. Just want to make sure. Yes. Okay. And then the thing here, this personal exemptions, that went away and now it's permanently gone. Okay. So the personal exemptions used to be $4,050 per kid. So like you can take your standard deduction, which was a low number, and then you would add this 4,050. Well, instead of doing that now, they just give us a higher overall standard deduction. And then but then we do get credits for our kids, and that still is in place. And so now what this was going to do is the credit was going to go down to $1,000 per kid, but now it's up to $1,200 more dollars per kid, so to $2,200. Okay, next one. Okay, here are some of the temporary items. Okay, so the no tax on car loan interest. There are some very, very strict income guidelines associated with this. So I'll just share with you what that is. So it phases out at 20% when your income exceeds $100,000 for singles and $200,000 for joint. Okay, so that deduction will pretty much go away for a lot of people, like quite a few. Okay. The enhanced deductions for the seniors. Okay. So I think the campaign thing was Social Security taxes not taxable, but actually you can take the 6,000 deduction like what seniors can, and it's per person. So mom and dad, 6,000 and 6,000, they get $12,000 in addition to that standard deduction of the 31,500, and in addition to their charitable contribution deduction. So now you can see how their deductions are adding up quite a bit. And so let's see here, and this is it's a temporary thing, and it phases out at a higher income. Okay, so the income that it goes to as single is 75 to 175. It starts phasing out again linear, and then for married filing joint, it's 150,000 to 250,000. And the important thing about it is it's not only for Social Security income, it's against all of their income. So if they have their IRA distributions, that can be used part of it. So like, let's say, for example, somebody didn't get $6,000 in Social Security income, or they didn't get $12,000 in Social Security income. They can still use it against their interest, their dividends, their capital gains, all sources of income. It's a $12,000 deduction. It doesn't just exclusively go after Social Security. Okay, the expanded HSA. We talked about the HSA a little bit. Okay, so the no tax on tips. Okay, so this one is kind of neat. It allows a 25,000 deduction. So in addition to the itemized deduction, or the standard deduction, the charitable contribution deduction, you also have this for tips. Now, what this does not do is it doesn't affect your payroll taxes, though. Okay, so like if you're still getting tips, you're going to have to pay your payroll taxes, Social Security and Medicare taxes on this. Then there's the no tax on overtime. Okay, this is a $12,500 for single, $25,000 for married filing joint, and this deduction is also temporary through 2028, and it phases out between these income levels. So 150 for single and 300 for joint. Now, the thing that's kind of interesting about this is just imagine how are we going to account for this? This overtime thing, right? Because like right now on our W-2, there is no number that says this is how much overtime you had. And then when you think about it like that, you go, okay, well, what exactly are they talking about here? Well, you know how overtime is typically like 1.5%, or it's like 1.5 times regular time. Okay. Well, the one is not affected by it. It's just the 0.5 piece that's affected by it. So I would be imagining that we're going to see like an extra line on our W-2s to account for it.
Hey, Patrick.
Yes.
Do you think employers are going to be responsible for providing them information
Oh, yeah.
on W-2 or 25?
Wasn't it delayed? But I saw something from the OSCPA saying that the reporting on the W-2s was delayed until 2026.
It's entirely possible, but like if I think about some of the other things that we've had to endure with tax law changes, like on December 28th, they changed that everybody was in charge of making sure that everybody had health insurance, right? So then we've got a new form in the tax return that says, hey, did you have new, insurance, yes or no, and how many months did you have it, and all this stuff. And the world was able to react and spin and make that happen.
But these are going back to January 25, right?
Mm-hmm. Yeah.
So that means people who have tips or overtime need to keep track of their own stuff.
Well,
the W-2 is not going to do it.
I'm thinking that there is going to be a mechanism in which it makes it easier for the employees. Now, that doesn't necessarily mean it's going to be easy for employers.
Hey, Patrick, that does take effect at 26.
Okay, so then they
So-
gave it up on the 25 to give us give people time, and then does it go to 29 still?
Doesn't say here. So you still get for 25, you still get the benefit of the no tax on tips, but the reporting mechanism doesn't really kick
So the
in.
employees have to
Yeah.
correct that on there.
Well, it says through 2028 for both of them.
Well, you were doing the tips one, but this is on the overtime. So the overtime, is that hitting in 26 also? So it'd be just 26, 27, 28? Because there are a couple of them that went from 25. There's one that goes to 30, and then there's like half a dozen of them that go till,
So other than the reporting portion, though, there's no change on the employer's side, correct?
I'm thinking
Still
not.
the
Yeah.
the
I'm
same.
thinking that it's going to be merely there's going to be some form of a box. I would envision because how in the kind of like in the middle they have the box 14, and it's kind of like left up for future use or for other things, and it could be a place where employers go ahead and put that number in there for people. So I mean, like I think that the W-2 will stay essentially the same as what it is. But then in that box 14, if I was doing it, if I was going to create it, I would do it in box 14.
It does look like that's changed to 26 too for the
We
reporting.
have IRS issued a ruling on that recently.
I'm sorry, so is it effective in 25, but just as an employer, you're not responsible for breaking it out on the W-2 until 26?
I'm thinking
Or
that
is it
you
all-
don't get the
Says,
deductions in
IRS
26.
IRS delays payroll form changes until 2026 under new tax law. Under IRS issued IR 2025-82 on August 7th. Confirming that major payroll reporting forms, including the W-2s, 1099s, and Form 941s will remain unchanged for the 2025 tax year despite recently passed on BBB.
Right, so I understand the forms of it. Just like, is it still in place? So if you sit there and do your own math and calculation, you can still take the deduction?
I believe so.
Yeah.
I think it's up to the employee.
Right.
Yeah.
Yeah.
Interesting.
Yeah, I think we're gonna get a lot of requests to run payroll reports
Uh-huh.
or timesheets.
Yep.
People can calculate that.
Should be on their page. There's coming
Yeah.
more guidance.
Yeah.
That's right there. You just gotta report the number.
Yeah. They're just gonna look for a report. or find it.
Yeah. Oh, I understand.
Okay, we're going to go through these last couple of ones really quick because it's basically no change in the rules there. So the casualty loss deduction, that's gone away because that was an incredibly crazy, form to complete pre-2017. You had to know what the fair market value of the property was right before the before the catastrophic event occurred. Okay. Miscellaneous itemized deductions. So this is things like unreimbursed employee expenses. They went away, but part of that was the lower tax rates. And everybody that was in alternative minimum tax back in those days never got those deductions anyways. I mean, it showed up on your return, but it didn't benefit you. So it was like a bunch of reporting for nothing. Okay. Moving expenses is permanently gone except for armed forces. Wagering losses. This is something that's new. So if you have gambling winnings and gambling losses, it used to be that you would report all of your gambling winnings on page 1 of your 1040, and then you could itemize and report your losses up to the extent of your winnings. So if you had $1 million in winnings, you'd report that on page 1, and you'd report $1 million of losses on their Schedule A, on your itemized deduction. Well, now it's you only get 90% of that number. So it'd be $1 million on page 1 and 900,000 on the Schedule A. But Ohio, so like any gambling that goes on in Ohio does not have a mechanism for reducing your gambling winnings. So even if you take $100 and you win $200 and you get $200 out, you're paying taxes in Ohio on the $200. And then same thing for local. Columbus doesn't have a mechanism for the reduction of any kind of losses on it. The estates and gift tax exemption. This one here was going to go down to 5 million, but now it's to 15 million, and it's permanent. And then it's also COLA adjusted. Next one. Okay, these are the Trump accounts. Okay, what these basically are is so for anybody that's born between now and 2028, they get $1,000 from the government, and you get to take this money out when you are 18 years old, or after 18. But it's sort of like an IRA. It's not a Roth IRA, but it's sort of like an IRA, in that you can take it out, and then there are things that you can exclude yourself from getting penalized. There's this 10% penalty if you take money from your IRA early, and you can use it for purchasing a home or qualified education expenses. It's kind of like work like that, and then other people can contribute to these Trump accounts too, or these accounts that are set up so people have some money when they're 18 years old. I don't know if a lot of people are going to, fund them fully. I think the limit is $5,000 maybe is what you can do in a particular year. I have that as a specific thing here.
You see much value in these.
Anything that forces people to save is probably a good thing, right? Because when Bruce comes in here, he's going to tell you about all the great things you get to spend money on and get to take deductions for. And so somebody's got to offset all that money going out, and it'll be, or all that money that's being saved. But let's see here.
All increased tax when it comes out, right?
When it comes out, it is. Yep, that's correct. It grows tax deferred though.
Yep.
So it's just like a non-deductible IRA.
It is the kids' tax.
But it is the kids, yeah. Yeah, parents and others can contribute up to a combined of $5,000 yearly, adjusted for inflation, and this starts in 2027. The child can use after turning 18 years old. It includes $1,000 deposit made by the federal government. Employers are allowed to contribute up to $2,500 tax-free to employee accounts. The account grows tax deferred until owners make withdrawal, which can only start at age 18. And it follows the rules of a retirement account.
Patrick, would you say that I'm born between this time and this time? What was that? For what, $1,000?
Oh, the years.
Yes.
Yeah, 25 to 28. Oh, that's right. You're a grandma.
I'm gonna be a second.
Congratulations.
That $1,000. Good.
Okay. Well, with the next part is not really a slide, but the a big thing that's going to affect individual income taxes is what Bruce is going to start out with, and that's the qualified business income deduction for people.
Bruce, you need to run your slides.
Either way.
Okay. Yeah, the remote's working.
All right, thank you, Patrick. So I'm going to focus mainly on those of you that own businesses and paying purposes. I've got 13 items here that, and obviously, if you have an S-corp with a partnership, that's going to affect you at the individual level too, right? So how you're taxed. So the first thing, as Patrick mentioned, qualified business income deduction. Everybody familiar with that? That's been around since 2017, UBI, we call it. So good news is the One Big Beautiful Bill Act did preserve this. There was some concern that maybe this was going to go away. And this is huge for anybody that's a pass-through into like an S-corp or partnership. So it preserves that 20% deduction. There was some talk about maybe raising that to 25%. That did not make it into the final bill. It's 20%, just like it's been. There's one carve out that if you have, there's a $400 deduction if you have at least $1,000. I think that's right. Because most people are getting 20% on their qualified business income. So you figure that's like a 40% instead of the first 1,000. But if you had $2,000, I think you're still probably getting $400. So I don't think that probably is going to affect too many people. Okay, second item. Oh, and I'm going to tell you, remind me if I don't say this, but I'm going to tell you when it takes effect and whether it's temporary or permanent. So this is permanent and it starts in 2025. It really continues in 2025. Okay. So catch me on these if I go too fast. All right. Pass through entity tax, PTE. So that is also permanent. And that also is continuing on in 25 like it's been. That's where a company can get a deduction for state taxes that are paid rather than you paying that at the individual level. Your S corp or partnership can pay those for you. There could be a deduction made at the company level that it's kind of a workaround with the SALT limitation that Patrick mentioned. So that's now gone from 10,000 to 40,000. Keep in mind that's temporary. That's not a permanent item. And there's also a phase out, as Patrick mentioned, if you get above 500,000 or so. So again, if you're high income, you're not going to get that $40,000 state and local tax deduction on your itemized deductions. You're going to get 10. This PDE is a way to kind of work around that. What do it through the company, get the deduction, so your K1 becomes lower, so you pay less tax through the K1. We'll pick that up on your individual return, and that's kind of. I mean, there's kind of some issues with that. You got to make sure that you're not getting a big refund because then that becomes taxable for federal tax purposes. So that's something that we're still kind of working through as far as exactly the model client or taxpayer that what conditions need to exist so that kind of works out the right way. So there's a lot of planning that has to go into that. So again, that's permanent. That's 25. The third item, excess business loss limitation, that has not really changed. That is let's see, that the new rules on that, so that gets indexed every year for the cost of living increases, but it's $313,000 of loss for a single taxpayer. It's $626,000 for a joint taxpayer. So that's pretty much the same rules that is in, but they did make that, they made that permanent as part of the One Big Beautiful Bill Act.
That's unlimited.
What's that?
Unlimited carryable.
Yeah. And that actually, the neat thing about that is that converts to a net operating loss in the second year. So we've had that, Ann and I've had this with a high net worth client where there's a big excess business loss that gets created and that converts to a net operating loss the next tax year that you file. So, so that can actually be, when you say carry forward, yes, but sometimes you can actually take that all like the next year, like if things work out right. So, AJ.
Is there anybody who shouldn't be looking at the pass-through entity tax?
If you're under like that $250,000 for the small business deduction that you get on your individual, then that's not a good cumulative. Against somebody that's going to get a big, so you don't want to pay the tax and then you're getting these big refunds because that conjugates the value of it. So it's kind of on an individual basis, but you have to have significant income to make it worthwhile. That would be kind of the first qualifier.
And being worried about that refund too, because they've paid a lot of taxes and that becomes the next income with that. So it negates the
Wherever it says there'd be no sole limitation as for entities, but it's passed through. Why is that there? Where are you trying to
Here, individual salt reduction is 40 for most scholars. Additionally, there'd be no salt limitation rest. That just means that you don't have the 40,000 limitation at the P company level. They're becoming So that's kind of that's what it's for doing this. Okay, so everybody familiar with our favorite topic, the employee retention credit? We always thinking this thing's going to die, but it keeps coming. Okay, so what changed in the OBBBA is that any claims made after January 31st of 24 that relate to Q3 and Q4, and actually for Q4 of 21, it was a very limited scope as to who could even get that. So, and actually I just had a client get a big refund, like $800,000 on this just this past week, but theirs was a Q1 2021. So the IRS is still processing 2020 claims and 2021 Q1, Q2. I don't think you can actually submit those now. I think we're maybe past the statute of limitations for that, which that had nothing to do with this bill. But this bill specifically said no more refunds are going to get paid if you did not request your refund prior to January 31st, 24 for those two quarters in particular. the thing they also did is they extended the audit period for the 2021 claims from 5 years to 6 years. So there's a pretty long runway here where the IRS can come back and try to claw some of this money back. There's a lot of fraud in the space that's part of doing that. So they've also enhanced the penalties for these ERC like providers that, you know, they say they were going to take a percentage of your fee, 20% or whatnot, and there's a lot of bad actors out there that kind of, you know, thinking this what was supposed to be kind of a good government program, you kind of ruin that with some of the fraud that's been involved. So that's ERC. Next item, let's see, 1099 reports. So some big changes are coming on this. So basically, like your 1099 miscellaneous forms, 1099 ADC forms that you would issue as a company, no changes for 25. So same rules there, $600 threshold. But you get into 2026, it goes up to $2,000. Okay, so that's going to probably be a lot less than 1099. So your company needs to produce 2 recipients for that year. But again, not till 26. That is permanent, by the way, too. So that's not going to go back. You know, it's not going to be 2,000 for a few years and drop back to 600. It stays at 2,000. And actually, I believe it gets indexed every year for possibility increases too. And then the other thing that kind of newer thing, but this reporting for like Venmo transactions and I've got kids in college and they're always like Venmoing money at each other. I thought, gosh, sure, they got to get some 1099K and I got to deal with that on their tax returns. And then if it's personal expenses, it's exempt. And they've also raised the threshold. So you would have to, this is almost like for like credit card type companies, you know, like if your company accepts say like Visa, then you probably get it to 99K showing like how much credit card receipts will pay to you during the year. So you got to have at least, it's going to revert back to what it was in 2021, 20,000 of activity and at least 200 transactions. So that, and again, if it's personal, it's not. So if you have kids, I don't know how to even use Venmo, but my kids use it. And so no concerns there. So,
The personal payments don't count towards that 200 transaction.
No. So if you use Venmo, Shara, as long as it's personal in nature, it's all good. There's no reporting there.
What's the 20K?
That would be like so let's say that you are accepting credit card payments, your business is, and you receive, let's say, 18,000 worth of like Discover card payments. So Discover would not issue you a 1099K for that because it's below the 20,000.
I see.
Yeah. But if it's 22,000,
Is it 20,000 and 200 transactions?
I believe it's both, yeah.
So if you hit 20K,
Yeah.
just one.
Yeah. Yep, and that's also permanent, by the way. 2025 is when that kicks in, that's this year. So this would be, you know, you're going to receive these 1099Ks probably in January. So those rules take like immediately. Okay, research and development expenses. This has been kind of a big thing the last couple of years. So for taxpayers that have R&D activities, not just manufacturers, it actually applies to a lot of different types of industries. But back in 2022, the tax bill that was passed in 2017, the Tax Cuts and Jobs Act, it pushed us off to 22, but it required starting in 2022 that all of your research and developmental expenditures had to be capitalized rather than expensed. You had to amortize them over a 5-year period if they were domestic, 15 years if it's foreign research and development that was done like overseas. So that has not changed with the foreign aspect. That's still a 15-year amortization. You still have to capitalize that. But now there's some ways to go back and undo what's been done on the past, I guess, for 22, 23, 24 years that for past capitalization that you had to do with these costs, you can now go back and either amend returns to get the money back, or you can take all of it in 25 that has not been amortized, or you split between 25 and 26. So that doesn't affect a whole lot of people, but that's a big change because that was just all of a sudden that was increasing. I had one client that their income went up like $5 million in taxable income because of this rule that took place in 2022. So that was the extreme example, but that was a couple of $1 million of extra tax that had to get paid. So that was huge.
What was the convention?
You could expense them immediately. So it didn't change the credit itself. It just changed how you treated the expenses related to the credit. So you have to capitalize them and amortize them over 5 years so they get the expense in one quarter. So now we're back to starting in 25 to expense payments in quarter, right? So that's back to the old rules, and that's also permanent. So that's good because There was some talk that maybe this would be like a temporary thing for like 4 or 5 years, and we're back to the same situation we were in before. But no, this actually is permanent. That's a very good thing that happened. We had a lot of clients reaching out to their congressperson or their senators to try to get this thing through. This has been going on for 3 or 4 years. So I'm glad they finally made some headway on this and get a good result there. Okay. Depreciation. This is something that's going to probably impact anybody here that's got a business. So the bonus depreciation rules. So those were in the process of kind of phasing out. We were actually at, I believe, 2025 before the law changed. I think it was 40%, right? So it used to be 100%, then they dropped it 20% every year. So I think 25 was the, you're supposed to get only 40%, then 26, 20%, and then it'd be 0 in 27. So bonus depreciation was going to be like a non-existent thing 2 years ago. But the One Big Beautiful Bill Act did actually address this, and I believe it had to do with when Trump took office on, I think that was Inauguration Day, January 9th. I guess it's after January 19th, so the 20th, I believe, is Inauguration Day. So any expenses or capital expenditures made, placed in service that day or later, it restores back to 100% bonus depreciation. So if you have something that you bought like in the first 3 weeks of the year that was before January 20th, you can still get 100% right off the bat. You just take the Section 179 expense, right? So you can still get full deduction there. But we tend to go bonus depreciation unless there's a reason not to. But that's our first. First of all, we create losses with that where we can't do it with Section 179. And if we wanted to do that as a strategy, and there's no limit on whether that's new equipment or used equipment. There's even like leasehold improvements if they qualify. Those can be used through bonus depreciation. Rolling improvements that are 15-year write-offs can be used through bonus depreciation. So that's a good thing to get back into play there. So that's going to really help businesses offset taxable income, and that starts again January 20th, essentially 2025, and that's also been made permanent. So you don't have to deal with this again in 4 or 5 years. The Section 179. So again, there's a phase out for that. If you place a service more than, they've raised that now to $4 million. So once you start getting above $4 million of new equipment or Section 179 qualifying assets, you start to see a dollar for dollar phase out of your 2.5 millimeter allowance. So once you get to 6.5 million, essentially you're done. 179, there's no options there. But that also is 2025, and that gets indexed every year for cost of living. So there's thresholds in that, but will go up slightly every year depending on what the inflation level is. Just got a couple more here. More to be precise. Okay, so business interest limitation. This is another big one because if you're a larger company, and I believe the threshold, they index this every year for inflation too, but I believe it's $31 million or thereabouts. That's in writing, and I think it's $31 million. So if you have a company above that, you have some limitations on your ability to deduct interest expense through your company, your S corporation, your partnership, and whatnot. The big change in this bill is that now you can take so think about what your taxable income is. And without this bill, what you have to do is you'd add back your interest expense to taxable income, and then 30% of whatever that number is, that's how much you're allowed to take in interest deduction. So let me just give you an example. Let's say you had a loss of $200,000 and you had interest expense of $500,000 to create that loss. So we'd have to take the negative $200,000, add back the $500,000. Now we have $300,000, right? We get 30% of that $300,000 as an interest expense deduction. So we don't get $500,000 of interest. We only get $90,000 in that example. The new bill, it also allows you to add back depreciation expense. So let's say you also had $1 million in depreciation expense in that same example. So rather than $200,000 loss plus $300,000 of business interest plus $1 million, let's say, for depreciation. So now we're at $1.1 million of taxable income. So now we get 30% of that $1.1 million, and we get a $330,000 reduction that comes out to, which again, we still aren't getting our full $500,000 we're getting for interest, but we're getting a lot more of it under this scenario. So in some cases, you can actually get all your interest. If you're a capital expenditure heavy company, that depreciation can be a fairly large number that could make it very easy to deduct all your interest. So that's only for large taxpayers. Again, 31 million on gross receipts. It gets indexed every year. It's like a 3-year look back average on that. But so that may or may not affect those in this room, but that would be the qualifier there. That is also a permanent item to add back that depreciation. That's pretty big if you're especially a capital expenditure heavy taxpayer. And that starts again in 2025. Yeah, absolutely. Yep. So I just did a tax projection yesterday for a client that did that, and it did make a huge difference on how much taxable income we ended up having in the end. So that was, I've already seen that in action where that's actually going to help people. Okay, 3 more to go. Opportunity zones. Everybody's familiar with those. Those are not super mainstream, but there's ways you, like if you have capital gains, you can essentially not pay tax on those capital gains by investing in an opportunity zone fund. And then if you hold it long enough, you can actually get scenarios where you don't even ever have to pay that tax. So they've now created a rolling 10-year opportunity zone estimation that's going to start in 2027. So the old rules didn't really change, but they've just kind of extended it out where there was kind of some, I think it was like in 2026, you had to like do something with the capital gains, and people that were like just getting into them now, I think they kind of maybe reduced what some of the tax benefits might have been if you had like done it now, versus without any kind of change in the law. So they've kind of extended it out to something more viable going forward. That's also permanent. So I'm not, honestly though, I'm not sure what happens after like this 2020 or 2033 period. I don't know if that's, it says it's permanent, but maybe there's some kind of mechanism that kicks in with like another rolling period at that point. I don't know, but more to come on that probably. So, and then charitable deductions for C corporations. So again, not S corps, not partnerships, not individuals. This is just C corporations. There's now, the only change is there's now a 1% floor on, normally you could be able to deduct 10% of your taxable income for charitable contributions. So let's say you make $100,000 in a C corp. Well, you could deduct $10,000 in the past for charitable donations. Now the first 1% you don't get any benefit for. So there's kind of a floor you have to get first. So like in that example, 100,000 of income, 10,000 of donations. The first 1,000 would not be deductible, but the next 9,000 would. And anything above the 10 total would still be like a carryover that you can take to the next year. But that starts in 26, not 25.
So Bruce,
Yep.
so is that first one not deducted, or you just have to be over that to get the deduction?
You would not get any benefit for that, in my example, for that first 1,000. So it's just kind of a non-deductible
Okay.
expense, just like meals might be or entertainment expenses or something like that. So, and then finally, electric vehicles. So if you're planning to buy an electric vehicle, you got about 37 days or so to get the benefit for that. 35 days maybe. So September 30th, that goes away, right? So you still buy it, so obviously at that point, but you just can't get the tax credit for them. So if you're thinking about going out buying a Tesla, you want that credit that's like, what is it, $7,500 or something? I think if the battery was here and how much it was assembled here and so forth. But this was, so if you go back a few years, there was what was called the Inflation Reduction Act a couple of years ago. That really expanded all this stuff in this, this alternative energy space. I didn't get it like most of this, but most of this bill, the One Beautiful Bill Act, is now kind of drawing back on all these things that got passed there a couple of years ago. So these are probably the things that are most prevalent, with our landscape.
And that's fully electric, not hybrid, correct?
I believe so. Yeah. So those go away. I'm not actually sure is there like a hybrid credit?
I don't believe there is. Okay. I think that all cars are kind of going to that hybrid thing though now. Like almost all of them, they're being
Like
manufactured.
the start-stop technology technically qualifies as a
Yeah,
hybrid.
it's CV or it's a continuous variable.
Mhm.
Yeah, these are specifically for the electric. So you have to be able to plug in.
We just bought a new hybrid vehicle last week, but it's not no plug-in. So.
Oh, both.
Check on that. We didn't want to plug in. It's too travel to charge.
Yeah. So again, if you're planning to do that, doing it for the tax credit, or you want to, you're going to buy one anyway, you get the credit, then you got to pretty quick on this. So.
Do you remember what the limitations are for the new and used?
I don't. The rules didn't really change with one versus the other. I know there were some issues with I think final assembly and where was the battery produced at, and they made it kind of restricted to make it more like, okay, we're going to do this for American-made electric vehicles.
I understand there's a website out there where you can put the vehicle identification number in and it'll tell you whether it qualifies and to what extent it qualifies. So it's kind of like you don't have to guess. It's there for you.
I believe they $7,500
Yeah.
Well, I think the newest one, there's a salary cap of, I believe, like $100,000. And then for the clean vehicle, I want to say it's 2 or 250.
And there were also some limitations too, like, of course, the manufacturers were going to kind of comply with this just to be able to move vehicles, but there was like some MSRP thresholds that you had to, like, it would qualify for like $50,000 EV or something. It had to be like under a certain dollar amount. And I think it was maybe different for SUVs versus passenger vehicles or sedans. Okay, so that's the business portion. Kind of leave the impact on the individuals. Again, there's more in the bill than what we presented. This is just, to fit all this in an hour. These were things we thought were important that you want to hear about. So we're a little bit over, but we're happy to answer any questions that anybody might have. Or you can always follow up with a phone call or email later too. That's fine. So. Okay. Yep.
You really the 1095s.
Oh, for the health insurance reporting, I don't think that was addressed in this. I think that as long as the Affordable Care Act is still there, I think that's gonna unfortunately still be an increase. But we'll see what happens next couple of years.
So just by a poll, which provision do you think is going to benefit your business the most? And which one will benefit your individual tax return the most? Just out of curiosity,
The R&D capitalization was the big one that
R&D is a very, very huge thing. The ability to be able to expense that now, that is gigantic.
The extension of the brackets.
The brackets affecting everybody, right? It wasn't just these people here get it. It was like everybody had a tax cut.
I say the state and local tax increase. They're paying way too much in property taxes.
Just keep in mind there's a phase on it too. So it's
It's couple of years. There's something else will change.
Which ones do you think don't affect your business very much or affect you? Like I was expecting too that bonus depreciation would be something, but because we had the ability to Section 179, people were going around it anyways.
honestly, I would answer that. I rarely see this, right? I could tell on one hand probably the clients that I've had to deal with on my vehicle, right? So it's just not that common. So
That one would affect us by taking it away.
the world affect you again. Yeah. To some degree.
75 years. We were looking at converting to electric, so I thought I would push it on.
Are those deductions on just the personal side or just the corporate?
These,
Yeah.
that is pretty much. That's,
So
how many of them can you take? Well, usually at the individual side, I think you're talking like one vehicle. I don't see the case street style or how that would work there. Like if you bought, like 10, I'm not sure if all 10 of those would qualify for something for sure.
It's per vehicle.
Yeah, it would make sense that it would be just like it's per employee for anybody that has employees in enterprise zones. It's that number per employee.
They're getting it more just to your way. We've talked about that if you're about something there. It's 5 weeks.
I was expecting the no tax on overtime to have a bigger impact, but since the employer only just has to do the W-2 reporting next year, it was just kind of educating our employees on their responsibility, but we didn't have to change anything in our payroll system. So
Yeah, because sometimes
salaries.
Hmm.
They don't get tips, they don't get overtime. How would below salary? Yeah, and we've got a group of kind of middle manager field guys that we were tossing around the idea of moving them to salary. And then this whole thing came up and we're like, yeah, this isn't the year to switch that up for their benefit because they can deduct that. Yeah.
and also being just on the 50% portion, not the whole dollar amount as well.
Or would it be a third, right? It's the yes, third. Yeah.
Of the two Bruce on that ERC, of many people are having difficulties in getting those funds back that would work for 12%. extensively. If that package, you have these backdoor channels set up with the IRS at their office, facilitate to get those funds moving.
Nice.
There's a group of us that, there's 20 of us, there's around $100 million sitting in waiting on refunds, and they got those out.
Okay.
That's funny
That's
how
good.
fast those checks get coming out.
That's good to know. So what he's talking about is like Troy Balderson, we do one of the Washington reps, for Ohio, and I know he used to be at our old office. He was our rep, and then I think they redistricted. I believe he's pretty much outside of Franklin County. Yeah, right. So if
Delaware.
Yeah. So if you're in Delaware County or Lincoln County, that might be a good avenue too. If you have a pending ERC claim that's not been refunded, and it's not one of these things that I just told you is not going to get refunded. So,
And the 6-year audit period is from when you filed it, or from when you
I would say probably from when you filed it.
okay, from when you received.
It was 5. They just extended it 1 year. So.
Oh, you guys have some great questions. I'll tell you. Yeah, thank you. Thank you.
Thank you guys.